We'll go ahead and get started this morning. So welcome everyone. My name is Bella and I'm your host for today's diversification webinar. As usual, I get the privilege of sharing some disclosure slides with you. So before I hand it over to Steve and Mike, this webinar is being recorded and will be made available to you on our website under the resources tab and also posted to our YouTube channel. There are two poll questions on your screen. Actually, there will be shortly. I'll go ahead and cue those up once Mike and Steve introduce themselves. If you haven't already, take a moment, answer those questions, and we'll get to those at the end of the webinar. And also at the end of the webinar, we'll be doing a Q&A session. So as questions come up during the presentation, feel free to type those into the Q&A box below, and we'll get to as many questions as we have time for after our presentation. Now that we're all squared away, Steve, why don't you take it away?
Good morning, everybody, and welcome to our webinar on diversification. What is it good for? I'm Steve Gormley, the Director of Portfolio Management here for the firm. The reason we titled it, diversification, what is it good for? It goes back to the old war song, what is it good for? Absolutely nothing, but we're definitely going to disprove that rumor here today. So usually we start this off with a little bit of a fun fact about ourselves, but the only fun fact that I can think about right now is I get to be a week from now and be on a beach in Hawaii and sitting back, having a nice cold drink with my family. So that's a fun fact. It'll be my first time in Hawaii, so I'm very excited about that, and that's all I can think about. So Mike, how about you introduce yourself? Take it away.
Yeah, Mike RAZZOUK. So I'm one of the executive wealth managers at KWB. I still have a 15-month-old baby, Steve, so I am not traveling outside of the state or the country or most times the city at the moment. But I guess my exciting news, I haven't really announced it officially, but you might have seen it on my email title. I did just complete a new designation in January. So now I'm a certified private wealth advisor through the Yale School of Business. So now I can say that I am an alumnus of the Yale School of Business.
Always nice to have that.
Yeah, it is exciting. But, I think it was one of the catalysts of why I wanted to, do this presentation with you and talk a little bit about diversification. It was one of the core concepts that they really kind of dove into through the curriculum. And so I think it's just a good reminder of why it's important and still part of people's portfolios and alive and well today. So before we jump into that, were you also having flashbacks from the movie Airplane as we were rocking out to the music here at the beginning?
Yeah, a little bit. That's a good point. I didn't think about that. That's funny.
Every time I hear that song, that's where my mind goes. So
yeah, very good.
One of the best scenes ever in a film. So anyway, so let's jump in with probably one of my favorite quotes when it comes down to diversification. So this is from Ben Carlson, who's a CFA. He's an analyst that we love listening to on podcasts. And he wrote, diversification is about accepting good enough while missing out on great, but avoiding terrible. And I think that's a good summary of it. When it comes down to a portfolio, everybody wants to be really concentrated in something when it's doing very well. And I guess what's kind of been happening with client meetings lately is, I have people who look at what the S&P 500 has done for the last 5 years, 10 years, 15 years. And the question is, well, why don't we just put all of our money there? I mean, obviously it just goes up and that's the best place to be invested forever, right? And I think we get trapped by what I call recency bias. You look back and you see something is done really well and you just extrapolate in your mind, hey, it's just always going to do extremely well. Yeah. And so it leads to overconfidence, which leads to other issues as well.
Well, I have a great story about that. When my wife, Kelsey, and I first got together, as you do when you're in this industry, you say, hey, can I look at your 401k and see how you're allocated? So
perfect question.
It was,
right.
Yeah, 6 months in, it's like, hey, let's show the 401k allocation. But, I looked at it for her and she was 100% invested in bonds. And this would have been in the 2009, 2010 timeframe. And so again, looked at her options in her 401k, and she said, well, all of these stock funds have sucked, so why would I ever invest in that? So she said she put it 100% into the thing that had done the best. And I think that's probably something you see in 401k statements when you sit down with new clients or younger people, right?
Right. Well, it's a classic mistake. You go back, you look over the performance history, you say, hey, wow, that's the best over the last 10 years. I'm going to put all my money there. But what I like to remind people of is we're not invested for the last 10 years. We're investing for the next 10, 20, 30, really for the rest of our lives. And so just because something has done well in the past doesn't mean that it's going to do extremely well in the future. Yep. And we'll talk about that concept on the next slide. So let's go there, Bella. I thought it'd be fun to kind of go back to the beginning of diversification. And really, I mean, it started foundationally with Harry Markowitz back in 1952. Harry Markowitz recently passed away, actually last year. So unfortunately, it seems like the financial sector with Charlie Munger, with Harry Markowitz, we're losing some of the great minds that really were foundational in some of these concepts. But Harry Markowitz basically said, hey, there's multiple ways to diversify portfolios. Yeah, you can put cash in a portfolio, you could put bonds in a portfolio. But what he was saying was, at its heart, when you add multiple risky assets, so if you had, say, 2 different kinds of stocks, you're actually reducing risk because the hope is, well, one stock is going up when the other might go down. And so we call that a correlation. So we'll explore that here a little bit deeper in just a second. But, he was basically saying, when you add multiple stocks, you're actually reducing risk in a portfolio over time and usually increasing its return or keeping a similar return. And that's always the goal. Hey, if we can have a good risk-reward balance, we'd all be happy. Yep. And then I love his other foundational concept, which was there's really, capital markets offer 2 free lunches, right? Diversification being one, which is what we're going to focus on, and then mean reversion, which we'll come back to a little bit later.
Yeah, mean reversion and diversification just go hand in hand. It's like, to me, it's like having 2 lunches at the same time, because what happens in markets is stocks will, make those big runs and everybody piles into them, 2000, 2007 come to mind. But, the mean reversion happens, and then what do you want to hold? Anything but stocks. So, that's when, those are the times when you really, really want to be diversified, is when the mean reversion comes to pass.
Right, exactly. So let's move forward. Again, Harry Markowitz really was foundational with applying the concept of correlations. So correlation is basically a statistical measure that says, what's the relationship between these 2 factors? And so we use this when we're evaluating stocks. So when you have a number of -1, it means something's completely, perfectly negatively correlated. When one's zigging, the other's zagging, in other words. When you have a correlation of 0, there's no statistical relationship between the 2. And when you got 1, it's perfectly correlated. So let's look at this visually, maybe on the next slide. I think it kind of helps a little bit more with the concept. And so when we look at correlations, so we want to find stocks that are negatively correlated. We want that zigzag effect. And what that means is when something in your portfolio is going down, hopefully there's something that's going up. And the reason why we like that especially is it gives you something to sell if you need income. If everything moved in exactly the same direction, it works wonderful when the market's just ripping and roaring. We're in a raging bull market, but it's when things start to go down that you're saying, oh, goodness, I wish that I was diversified. And so diversification is always this love-hate relationship. You want to be concentrated when things are doing great. You want to be extremely diversified when things aren't going well. We just don't know when that's going to happen. And so that's why you're always looking for this negative correlation effect in your portfolio, so you have something that you can sell when other things are doing poorly.
Yeah, the big one for me, when you build a portfolio, you want those positive and negatively correlated assets, but the non-correlated, the no correlation assets are also super important, because it really changes that risk profile. And then while one thing's zigging, the other's zagging, that thing might be zugging. So it's like, you have getting all 3 of those different components can be really, that's the perfection of portfolio building.
So let's go on to the next concept here. I mean, the reason why we're really trying to do this in the end is reduce risk. That's the bottom line with diversification, is we want to reduce risk. And so really there's 2 types of risk when it comes down to investments. There's what we call idiosyncratic risk and then systematic risk. So idiosyncratic is basically, let's call it diversifiable risk. You invest in a company, the CEO does something wrong, the stock price goes down, or You know, they make a poor investment. It's a biotech company that doesn't get FDA approval. That's idiosyncratic risk. It's the risk of a single company or a single sector of the economy. And so we say, hey, well, if you own multiple stocks or if you own multiple kinds of stocks, we can diversify that risk away. And with systematic risk, it's the broad market. You know, there's always inherent risk of just being invested. You know, look at what happened in 2022 when the Fed started raising interest rates. It didn't matter if you were a big, small, foreign, domestic company, everything was getting hit negatively. And so that is just inherent risk for being invested in a market that you can't necessarily mitigate with diversification.
Right. And the other thing to think about nowadays, with respect to idiosyncratic risk, it might not just be one company. It could be a whole sector where, you know, we've seen a lot where other asset allocators might be really heavy into tech. And, you know, if you're just in the one sector, as we saw in 2022, that sector really pulled down the market, while other things, you know, value stocks were flat for most of the year and maybe barely negative. So one of those things that idiosyncratic risk can transfer itself from just a stock to sectors of the market as well. So you know you want to diversify beyond that.
Right, exactly. So let's move on to the next concept here. I mean, this is really giving us a visualization of what happens with correlations, and I think this emphasizes just the inherency of systematic risk. And so what we could see here is kind of that correlation between different kinds of asset classes. So usually within a portfolio, we might own large US companies, we might own small companies. And what we find is they tend to have, you know, some correlation. They're obviously positively correlated here in the top left chart here, but they tend to move at different times. And that's what we like to see. You know, lots of times small companies do well at the beginning of a growth phase. And towards the end of one, you don't want to own them that often. We also get that with different markets. So that's why we fold in international companies, for example, because again, there's a diversification effect that happens with them as well. So we're able to, you know, get rid of idiosyncratic risk, not just with owning multiple companies, but also multiple countries. But it really isn't until you start to fold in a completely different asset class, like say bonds here. So when we look at the bottom left quadrant, we can really see that zigzag effect, right? When stocks are doing poorly, lots of times bonds do really well. It wasn't the case in 2022, but historically that is. And so that's why owning multiple asset classes can also be a benefit to a portfolio and just aid in that diversification effect.
Yeah. And Bella, let's go to the next slide, because I think this shows it from an asset allocator's perspective. You know, what we hear, or what I hear a lot, is I just want to be safe. If I could just be safe, then I'll be happy. And so you can see this chart. This chart is showing different portfolios constructed over 50 years, from 1970 to 2019. And being 100% in bonds, while it seems safe, you know, it is not the safest that you can be over a long period of time. I think when people say I want to be safe, they're always thinking, oh, for the next 6 months. But the next 6 months turns into a year, turns into 2 years, turns into 5 years. And then you're not as safe as you think you are. Over that 50-year time frame, the least risky portfolio had 33% stocks. So a third of your portfolio was in stocks. And the great thing that I always love to see on this chart is the portfolio that most of our clients tend to fall into, a balanced portfolio of 60% stocks, 40% bonds, was actually less risky over that 50-year time frame than being 100% in bonds. And you know, that's where the rubber meets the road for asset allocators, and that's why we're thinking not over the next year, we're thinking over the next 10, 15, 30, 50 years. This is how you allocate a portfolio to be less risky over time.
Right. This is a neat concept, because I mean it really illustrates what Harry Markowitz was saying. Bella, can we pull up the chart one more time? I want to annotate it a little bit. So it really shows the concept of what we call the efficient frontier of investment. So that's basically this line here. You know, it's showing that anything below that line is not something that you want to be invested in. And that's what happens with a 100% bond portfolio. You might think, oh, it's less risky, it's all bonds, but the fact is you're not getting that correlation, that inverse correlation effect with adding stocks into that portfolio. You actually get the benefit from that diversification, and that's how you end up, on that efficient frontier. So like you said, it's actually less risky folding some stocks into your portfolio. And so when somebody says, I'm a conservative investor, and they want to be all in bonds, it's just a misconception. It's kind of that false safety. And I would say even the other false safety over time has just been the person who wants to be all in CDs.
Yeah.
They feel like, hey, I'm not losing money, but in reality, you're not making any real return, especially when inflation, is as high as it has been.
Yep.
So yeah, actually folding stocks into a portfolio gives you less risk and better return. And that's something that as investors, we're all seeking.
Yep. So let's go to the next chart, Bella, and we'll see it put into practice here. So this is a quilt chart. I'm sure many of you have seen this in your advisor appointments, that shows over the last 15 years what all the different asset classes that we might invest in have done. And then in the middle, connected with the line, is what a globally asset allocated portfolio has done over that time. So you can see on the left-hand side, what has done the best: large cap stocks. So that's the S&P 500. But if you look year to year, what has done the best? Large cap stocks has only done best twice, 2019 and 2023. So if you were really, gung-ho about large cap stocks, there was other areas of the market that you could have invested in that did better many of those years. Now, over that 15-year period, yes, S&P 500 did great, but look at an asset allocated portfolio over that time. This is globally allocated. We know that the S&P has done the best over that time, but you still got 8% over that 15-year time frame, and you had much less risk. I calculated it's about 40% less risk to be globally diversified than it is to just be in the S&P 500. Right. So it's a big leap when you add in these other asset allocations.
Yeah, and I think it is a neat story to be able to look back and see this chart. I mean, I always joke and say, it'd be nice to get this chart for the next 15 years, right? Know exactly where to put people's money. But I think what's important to capture here is it's like, just because something's done the best over the last 15 years, that doesn't mean it was the best every single year. And so you've got these big chunks of return at key times, especially with the S&P 500. It was like 2017, it was 2019, 2023. But there was a lot of other places where other asset classes did add substantial value. So having that exposure to small companies, to real estate, other things in the portfolio actually were better at different times. It's just you got these big pops, a couple years at a time over the last 15 years, and that created the outperformance.
And you talked about having the next 15 years. Well, let's look at the 10 years prior to this. So Bella, go to the next slide. The best place to be: real estate, number one, over that 10-year period from 2000 to 2009. But then emerging markets, you've got bonds that did even better than an asset allocated portfolio. The worst place to be over that 10 years was the S&P 500. So how many people at the end of 2009 were clamoring, I just want to be 100% in the S&P. I know this is the best place to be. But what I love to see over that 10-year period is the balanced portfolio still, S&P down 10%, a globally balanced portfolio still did probably about 5.5% annualized over that time frame. So how, this is the proof in the pudding of asset allocation and being globally diversified.
And this comes back to what Harry Markowitz was saying with reversion to the mean. Lots of times the things that did the worst become one of your better performers over the next period of time. The thing that did the best might become the worst. And so it's good to just kind of be in the middle, own lots of different things so that you're not living on these extremes. And I do think that, that's why we literally called that the last decade. You didn't have positive return if you were invested in stocks. And so you needed diversification to be able to generate the income that you needed and you know, to not run out of money if you had retired during that time period. So
yeah, and it wasn't a lost decade if you were diversified. You know, the proof is in the pudding right there. And let's even show more of that, of how it works in practice. So the next slide is dealing with a person who just, let's say this person just retired. They retired with $1 million starting value of their portfolio, and they wanted to take 5% per year, so $50,000 per year. And this is the person who retired right in 2000. So they retired. Bella, can you
right at the worst time?
Yeah, right at the worst time. They retired right when it was not the time to retire. So if they would have been 100% in the S&P 500, they would have taken about $650,000 over this time frame, and they would be underwater. It would have been better for them to just sit in cash and pull from their portfolio over that time frame if they decided the S&P 500 was the place to be. Now, if they just added 40% in bonds into that balanced portfolio that we talked about earlier, they ended up with about $750,000. So that diversification of saying, all right, I have a place to pull from bonds when stocks are not doing well, gives you almost double the return of just being not diversified, undiversified. Yeah. So let's go to the next chart and show being globally diversified in that time frame. So instead of the 60-40 portfolio, this person decided, I'm going to be globally balanced. I'm going to have lots of different assets to pull from at different times. Again, they took that $650,000 in the globally balanced portfolio, the pinkish orange line. You end up at the end of that, at the end of 2012, with $1.6 million in your portfolio. So you have more than you started with.
And I love that you're sharing that, Steve, because especially the last 15 years, it wasn't that just, buying large U.S. companies was the best. I mean, it really caused people to question international investing. Mm-hmm. You've just seen this concentrated outperformance in U.S., but we forget, again, the historic context that lots of times international stocks have outperformed U.S. market. And so just adding those other markets, again, we get that negative correlation effect. And it was very substantial to helping people build wealth during that period of time when the U.S. markets were in turmoil.
Yeah. And now I don't want to, let's go to the next slide, Bella. I don't want to say, this is the only place to be. Let's look at the time frame from 2013, the last 11 years or so. And yes, the U.S. has outperformed. And if you would have started with that portfolio at the end of that first period and started in 2013 when you retired, you would have done better just being U.S. based. However, the thing I love to look at is if you were in that globally balanced portfolio, you still end up above where you started, and you're taking that $50,000 a year. So a globally diversified portfolio is still giving you the benefits. It's just not as great. But when Mike and I are thinking about allocating a new retiree today, we don't have that quilt chart for the next 15 years. Right. So let's look at that quilt chart and say that's the place to be. No, you can go to the next slide, Bella. That's fine. So let's look over that whole time frame. And the way I think about this is a time frame of someone who is retired till the end. This is how you want to be allocated for that whole 24-year period. And if you started with that globally diversified portfolio, you outdid by 2 times what a U.S.-centric portfolio would have done. And you took more than your $1 million out already, and you get to pass along to your heirs 2.2 instead of 1 million.
Right, and I think that really emphasizes the concept. I mean, we say in investments, the most dangerous words are, this time is different, right? You've got people who say, well, the U.S. companies are just so much better than international now, and it's just different. And I guess what we have come to find is that's never been the case. Usually we get that mean reversion, and it's very important to still have that diversification effect in somebody's portfolio. So when we talk about long-term, we're not talking about a 5-year period. We're not talking about a 10-year period. We're talking like a full market cycle, which could be a 20-year or a 30-year period. And this is really the emphasis that we try to bring to the table with clients and asset allocation is, you don't want to begin at a period of time like 2000 and be concentrated. The diversification is what saved your bacon and helped grow your wealth. And so over a complete market cycle, a long period of time, you're going to benefit with more return, with less risk from a globally diversified portfolio that has international companies, that has some small companies, and that, still has large U.S. companies at its core, but not its only holding.
Yeah, that's the thing to note is it's usually a very small or a smaller portion of your portfolio than those large U.S. companies are. This globally balanced portfolio still probably had 40% of stocks, of U.S. stocks in it. So it's definitely tilted towards those large U.S.-based companies. But by having those differences in correlations when you're taking the money out, you get the benefits over that long period of time. And let's go to the last chart, Bella. This is just showing U.S. outperformance versus international outperformance, and we go through these large, long cycles. So you wanted to hit on that, Mike?
Yeah, I think what my takeaway is you look at the far right here, where we've had U.S. outperformance now for over 14 years. And like I said, it's dangerous to say, well, this time is different. It's dangerous to think that that's just going to continue to go on forever and that we should be even more concentrated in U.S. stocks. I mean, this is really strengthening the case of why people should have even more, international exposure, because the outperformance comes in cycles. And we've been on the biggest run of U.S. stocks. So it's possible that we'll see that mean reversion that Markowitz had talked about. And so it's wise, it's smart, and historically it's been accurate to, again, remain diversified and have exposure to international companies within a portfolio.
Yeah. All right, Bella, that was the end of our talk.
All right, perfect. Now, should we go over the poll question, Steve?
Sure. Yeah, let's do that. So yes, the largest stock in the world by market cap currently is no longer Apple. It was Apple for quite a long time, but now it is Microsoft. So 5 of you out there got that correct. NVIDIA, I love seeing NVIDIA. I added that just because it's been on such a tear recently. But yes, Microsoft right now is currently the largest company in the world.
Did all that happen just within the last couple of months, Steve?
Yes, it is very recent. Apple
was on a 17%, like 18% drawdown?
Yeah, correct. Yeah, and Microsoft has continued to, I think it's been, the performance at least year to date is in line with the market. But yes, it has taken over Apple as the largest company in the world. So what is the current percentage of the S&P 500 to the 10 largest stocks? So actually, everybody did really well. It is 30 to 40%. It's about 32% as of a few weeks ago. So it could be more or less, but it is in that 30 to 40 range of the 10 largest stocks in the U.S. make up about 32% of the S&P 500. And so the last question I had was, which is larger, the stock market or the bond market? And unfortunately, it is the bond market. The bond market is a couple trillion larger than the stock market. Actually, it used to be much, much larger than the stock market. And internationally, the bond market is about, I think it's 10 to 15 trillion larger than the global stock market. So not only is it bigger here in the U.S., but internationally it makes up even more. And so a true market cap or market cap weighted portfolio actually would be tilted more to bonds than it is to stocks. But as we talked about, you actually might be taking on more risk by having more bonds than more stocks. So yeah, just 3 interesting questions that I thought would be good. So yeah, Bella, do you want me to read the questions?
Yeah.
Okay, so we got 2 questions here in the Q&A. Are there specific sectors or industries that you recommend for diversification in the current economic climate? I would say no, none specifically. You know, you're getting that diversification through the various, you know, holdings that you have within a portfolio. You know, the thing about different sectors or industries is that they're going to move and zigzag at different times, just like we talked about. So there's no, you know, for diversification, you want to hold all of them. You know, that's what I would say. There's none that you don't want to hold is basically what it comes down to. It's just what proportions do you want to hold them in? You know, that's the harder question.
Yeah, I think what we might tend to do is add like a little bit of a sector fund if we're doing a trend following model that, you know, might overweight at the moment tech. It might overweight consumer staples or discretionary. So there's going to be different times to own different asset classes, and they tend to perform differently depending on the market cycle.
Right.
So when everything feels really good and you're high on the hog, I mean, lots of times you're going to prefer being invested in financials, healthcare, you know, something that's going to be a little bit more defensive versus your high flyers, your expensive stocks like your tech. So, you know, at this point, I think that we tend to be pretty neutral. I mean, most of what we're doing still is market cap weighted. So it is kind of following and overweighting a little bit more towards tech at the moment. But yeah, I wouldn't say there's a particular sector that we're trying to pour money into at this particular time.
Right. Second question is, how does the current interest rate environment affect our diversification strategy, particularly in relation to fixed income investment?
Oh, that's a really good one.
Yeah. Do you want to? Yeah, go for it. This is a good question.
So I think when it comes down to the diversification right now, what we've done is we've actually overweighted stocks in people's portfolios. And what I really love to do, I wish that we had it right now to be able to share, is I go back on Y charts and I show like, hey, if you invested, say in 2022, I mean, January 1st, 2022, where would you be today? And what's interesting to see is actually the stocks have fully recovered. We've reached new highs. But when you look at like the bond aggregate index, it's still down. I mean, it's still down 13, 15%. And so what we've tried to do with the current interest rate environment is actually overweight stocks a little bit, just thinking that, hey, if interest rates do begin to fall, it'll be better for stocks overall. And when it comes down to fixed income itself, you know, we've definitely been shorter term. So we've been investing in fixed income that is going to be less affected by what we call duration risk. That's basically what's the average maturity of the bonds in a portfolio. And so when you have a shorter duration, the bonds are going to move less when interest rates rise or fall. And so you want a short duration when interest rates are rising. You prefer a longer duration when you think interest rates are going to fall. And so we might be making shifts towards longer duration bonds soon. But, you know, today's Fed Day. Happy Fed Day, Steve. And we're still kind of eager to see what direction the Fed is really going to do. You know, people are expecting rates to fall, but the economy's still been strong. Inflation numbers have still been high. So, you know, we might see less rate cuts this year than people originally anticipated.
Yeah, I would say just from an attractiveness standpoint, bonds are definitely more attractive than they were for a very, very long time. So it's nice from an allocator perspective to say, hey, at least if you are in a 60-40, you have 40% that's actually giving you some return nowadays that it wasn't giving you for a very long time. But when it comes down to it, interest rates are, and interest rate policy is impossible to predict. You know, the prediction going into the year was that the Fed was going to cut 6 times. Now it's looking like 3, and you know, some people out there are saying 1 or 0.
Right.
And you know, look at any long-term chart of the predictions of where interest rates are going to be and where they actually went, and you will see a chart that looks like people have no idea what's going on. So, you know, so there's no rhyme or reason. So really, when it comes down to it, it's nice from an allocator's perspective that we get some return out of those bonds. But other than that, it's, you know, the interest rates and where interest rates are going are kind of secondary to where we're thinking about it. You know, more to Mike's point, thinking about it from a stock perspective, how do stocks do if the Fed is going to cut and things like that?
Yeah, I think you touched on it well, and I'll just highlight what you said with regard to buying bonds now. It's an attractive entry point. And so when people still have money on the sideline, or they have money in CDs, treasuries, something like that, bonds are an attractive story. You're getting 4.5%, 5%, 6% yield, and you have the chance for price appreciation if interest rates do fall. So the price of bonds is an inverse relationship with interest rates. When interest rates fall, you get a boosted price on bonds that you own. So it is an attractive story going forward. But again, I think it's just important looking at that duration and just making sure that you're at a good point in the yield curve. It seems like nobody wants intermediate term bonds, right? All just either short or long at the moment.
Next question: can a diversification strategy address inflation risk? 100%. So really, when you look back at history and when inflation hits, the best place to be is stocks. So the diversification, or the I want to feel safe, especially in times of inflation, of going to bonds is the exact wrong strategy. Because basically what you're doing is, if inflation is running higher than the interest rates you're getting on your bonds, you're automatically losing money. Same with sitting in cash. If you're sitting in cash and it's yielding less than the inflation rate, you are losing money day by day. Whereas stocks have the ability to pass on the inflation costs that they're getting it to their consumers. And so stocks are typically the best place to ride out big bouts of inflation. Now, in 2022, we didn't see that necessarily, but the reason being is the Fed is also raising rates at the same time. But as we've gone through the full cycle of inflation, stocks have obviously been the best place to be, as Mike pointed out earlier.
Right. And I mean, the big reason for that is the companies they're the ones raising their prices. I mean, they're pretty much causing inflation. So as they're raising their profits, they have better earnings, which usually lead to higher stock prices. And I'd add, you also lots of times will see commodities tend to do well. So like having a diversified allocation to some commodities or alternative investments can help during bouts of inflation. It's just, you absolutely hate them the rest of the time. Like when the market's ripping and roaring, you don't want those at all in your portfolio. You go back to that quilt chart that we had that showed the best asset classes. You look at the bottom of that chart for the last 15 years, and it's been commodities, metals, things like that. So you can diversify it. It's just, can you predict it? That's the hard part with it.
Right.
So you might see a small sleeve to alternative investments in a diversified portfolio, but again, it's not something that tends to be beneficial for long periods of time.
Right. Next one: how frequently do you diversify your standard portfolios? So all of our portfolios that we currently run, models that we currently run, are all globally diversified in some way. We might trim or add at the edges of those allocations, but when it comes down to it, we're not going all in on certain things and all out on certain things for the most part. So it is one of those things where we might tinker with the allocation when we feel good about certain sectors or certain spots in the market, but when it comes down to it, we're always globally diversified. Going back to the long-term charts, that's where we want to be and probably want to stay. It's just we will tinker with things if we think we can add a little bit of value, during certain time frames.
I guess what I'll add is just the moment that you think that you have it all figured out is the moment that you've just displayed the most ignorance when it comes down to the markets. And so the people who say, oh, this is going to happen, the majority of the time they're wrong. And so it's always good to just have a good mix and look at it. Hey, I can't predict it. I'm just going to be invested through this storm. And I would say it's important to still have those emergency funds. We always encourage people to do that when it comes down to surviving a bear market. I say you can't predict one, but you can prepare for it. And so just having some cash, having safe investments that you could go to and tap into during those drawdowns is what really helps people get through those types of events.
Right.
So
Next question, would long-term corporate investment grade bonds be a good place to invest today? Again, I think that comes down to a conversation with your advisor more than anything else. Your time frame, you know, what the money is going to be used for. There's lots of conversations that you need to have before deciding, is this thing good for me or not? You know, that's generally the way I think about those types of questions.
Yeah, I think, like, broadly speaking, yes, you know, it's an attractive entry point, like we had mentioned on a previous question, because you're getting a higher yield than what we've experienced for the last, 15 years now. I mean, interest rates were so low for so long that when you look back to long-term historic returns on bonds, it's been pretty dismal. But now you actually are getting attractive interest rates with the possibility for price appreciation. So yeah, it's not that you should like try to specifically just add money to bonds, but I think that if you were investing and a part of your portfolio is allocated to them at this point, it's likely something that you'll look back on, you know, over the next 3 to 4 years and just say, yeah, you know, that was a good investment.
Another question here. I learned a little bit about negative correlation for diversification in my statistics class, but the tool seemed relatively simplistic, and I wondered if there are more sophisticated models used in the industry. 100% there are more sophisticated models. The problem with models is that they're always changing. They change the models constantly, and you have to put in your own assumptions about what things are going to do. So the models are great for hoping, but they don't in practice are you know, they're useful but not extremely useful. So it's more, as to Mike's point, be diversified, be globally diversified, have lots of different assets, and that way, because we don't know what's going to happen, that way we have places to pull from when things go bad. Yeah.
There's a, I'm trying to think of like what the right word to describe it is, like a fallacy or something with models, and basically you don't know what the problem is. Is it the inputs? Like, hey, we just didn't have the right inputs, we didn't use the right assumptions, or was the model itself inherently wrong? And you'll never know the answer to that because you can't predict the future when it comes down to markets. So yes, there are extremely complex models that people use, but when it doesn't pan out, you just don't know what was broken, the assumptions, the modeling itself. And so you can have all the theory in the world and it's not going to come to fruition. And we always say the markets are the collective emotions of everybody out there, and that's very unpredictable. So it's just not, there's no perfect model. If there was, then somebody would have it all figured out and, you know, make trillions of dollars in the market.
It looks like this is our last one. With your standard portfolios, how do you choose what specific bond stocks to go into and how often? So different models have different rebalancing schedules. We're never we don't really pick individual stocks and bonds. You know, we're really broadly diversified through all of our typical models, and so there might be sectors, or there might be like, let's overweight large cap growth versus large cap value. Let's underweight international. So we're always completely diversified. We're just tinkering with the percentages that we might be in something when we see good value in places, or better earnings in places, things like that. So it's not necessarily choosing stocks and bonds. It's more choosing larger sectors, larger places to place the money, and then tinkering with the percentages that we might be in those things.
Yeah, I would say when it comes down to allocation, like, we tend to create a core holding. So if it's a 60-40 portfolio, you know, we choose we're going to have 60% in stocks, 40% in bonds, but then we might overlay that with an overweight towards growth companies, towards value, just depending on where we are in the market cycle. But, you know, we're not doing it typically with individual stocks. We're not doing it with individual bonds. We believe in indexing, and we think that it's over time very difficult to outperform indexing. And so it tends to be lower cost, more diversified, and it's just given people, frankly, better returns over time. And so we just kind of create a core portfolio and then have a little bit of a tilt on something depending on what's happening with the global market cycle.
Thank you for all the questions. Bella, you want to close us out?
Yep. Just a few announcements for you all. A big thank you, first of all, to Mike and Steve for an excellent presentation. And thank you today for joining us. You'll receive an email from us shortly with a short survey asking for your feedback. Of course, we'd appreciate your feedback on that. You'll also be hearing from us or receive an email when this recording is available on our website and YouTube channel. And if we didn't get to your question today, maybe you didn't want to type it in the chat, please send an email to invest@kwbwealth.com and we'll make sure to get back to you there. Aside from that, thank you so much for joining us.